Welcome back, friends. Today, I'm out here in the woods, and I'm going to be explaining fractional reserve banking. Just to get right into it, fractional reserve banking is the process by which banks lend out more money than they actually have on hand. And through this process, this is why lending essentially creates money. And so I'm going to be explaining that in this video. Might make you a little bit frustrated at the banking system. You might feel like you're being conned, but at the very least, I hope you enjoy this video and I hope you learn something and I hope you liked the new setting for the video. So, fractional reserve banking, as I said, banks lend out more money than they actually have on hand. How does that work? Well, it's right in the name. I know it might sound a little mysterious, but let me break it down for you. Fractional reserve banking. The last part, banking, is obvious. We're talking about banks here. That's pretty self-explanatory. Why is it fractional? Well, the bank loans out more money than they have on hand, as I mentioned. So, in essence, they're only keeping a fraction of the money you deposit with them on hand. And that money is referred to as their reserves, the bank's reserves, which is basically just the bank's cash, right? Banks, unlike other businesses, they really only deal in cash. You know, in another time they dealt in gold and silver, but they really only deal in money, currency, and loans, paper, notes, bonds, what have you. They don't have, inventory, or they don't sell, produce or whatever. They're just banks. They're financial institutions. So if you go to a bank, let's use a little example here. You take $1,000 and you deposit it in your local bank. What they're going to do is take a fraction, again, fractional reserve banking, of that $10,000, let's use 10% as an example. They're going to take 10% of that $1,000 or $100, hold on to it in their super secret safe bank vault, and they're going to lend out the other $900, right? So right there, you can see that money is being created. It may not be very obvious, but let's, break into it a little deeper. You have $1,000. That's real money. That's currency. Let's say it's $1,000 cash. Most money nowadays is digital, but we'll just, for the purposes of this video, think about physical cash. You deposit your $1,000 in your local bank. They say, great, we'll take your $1,000, we'll keep it safe. You have $1,000 in your checking account. You can take any time. That's what's known as a demand deposit for the bank, right? So for the bank, it's essentially a liability. You can come get your $1,000 anytime, right? Now, the bank makes money by loaning out your deposits, which they're keeping safe for you, to people who need loans to buy a house, to buy a car, for a credit card, whatever they need a loan for, right? So they'll hold on to $100, like I said, 10%, and they'll lend out $900 of your money, right? And right there, as I said, we've created money because now you have $1,000 in your checking account, and the bank has made a loan to someone in the amount of $900. So as you can see there, $900 was just created and added to the economic system, right? There's still only $1,000 physical cash, right? The bank is showing, again, most cash is digital nowadays because the bank is showing on your account balance $1,000. But then they also made a loan to someone else and their account is showing $900. And the way that this system can kind of be perpetuated is both you and the other person probably aren't going to go withdraw that money physically, and especially you're probably not going to do it all at once, right? So that person now has $900 in their account, they got a loan. They're probably just going to use that digitally, and it's not really going to matter. And the bank can just transfer money around to other banks. And again, as long as those other banks don't come and request the money physically, it doesn't really matter. So one other thing that I want to touch on in this video, this is where you're really going to get a little frustrated or at least a little perplexed in our modern monetary system. The Federal Reserve would long control this creation of money by lending it out through commercial banks. They'd kind of have their finger on the button here by controlling that ratio that banks have to keep on hand. And this was called the reserve requirement. And I didn't just choose 10% randomly. 10% has historically been pretty common for the reserve requirement. Most banks hold on to about 10% of their reserves and they lend out the rest. That's very common. It's been common, for hundreds of years, 10%. But in 2020, due to the economic hardships of the time, the Federal Reserve removed the reserve requirement entirely. It's now 0% in March of 2020. So, or it might have been 21. I actually can't remember. But nonetheless. So as a result, that's kind of crazy. You're basically just giving banks free license to print as much money as they want. The only thing that's going to kind of put a limit on how much the banks are going to create is the possibility of a bank run, which has happened before. Bank runs are basically when, like I said, the bank's counting on you and this other person and all their customers not withdrawing their money at once, right? Because they're loaning out more than they actually have. So if everybody withdraws their money at once, the bank's going to become insolvent. They're going to run out of cash to meet their obligations to their customers and basically go bankrupt. And this has happened many times before. Now, I will say with that the Federal Reserve kind of exists as the lender of last resort to prop up these failing banks. But nonetheless, that's really the only reason the banks they can't just loan out as much money as they want, is because eventually, the more they loan out, the further their loans outstanding get from their actual reserves, the more likely a bank run is. So back to the reserve requirement. So the Federal Reserve in March of 2020 removed the reserve requirement entirely. And it's never gone back. So banks can just loan out as much as they want. It's basically up to their discretion how much reserves they need to keep on hand. And as such, this is, one reason why inflation is so bad. Commercial banks can just loan out as much as they want, and when they make these loans, they're creating money. So that's about it. I hope you enjoyed this video. I hope you got something out of it. Let me know if you like the new setting, and let me know what you think about fractional reserve banking in the comments below. Thanks for watching.